Moving on with the next guest of the show, we have Sandeep Bagla of Trust Mutual Fund. Sandeep, good morning. So good to have you on the show.
Good morning to you. Thank you for having me on the show.
Sandeep, there are some conversations around, how we could see some temporary pullback. Today, of course, has been one of the example as well. But how much of a recovery can we see? Is it enough to fill up the 11% or 10 to 11% correction that we've seen from September peaks?
No. I think we should take a longer term view. I think what is happening is that the earnings season has been somewhat disappointing. There have been downgrades on the earnings season, and the flow of liquidity, while the domestic inflows have been quite robust, we have seen steady outflows from FPIs both on equity and somewhat on debt side also. So there are uncertainties building up which are of different nature with the change in leadership in the US. The policies of the Trump administration are going to be clear only in the next few months. And there is going to be some reallocation of capital dependent on what is the impact on different economies. And I think markets do not like uncertainty. So I think one should not expect a very sharp pullback in a short span of time.
Okay, all right. But Sandeep, what could be the next big trigger for the markets? Because we've seen majority of the catalyst go out. We had the US elections, we had the Fed's meeting, we had the inflation reports. So what are the next trigger that the market participants can watch out from here on?
I think the next big trigger would be probably the unveiling of the Trump policies that will come.
Okay.
And this earnings season is, already more than halfway over. So I think we will have to wait and watch for the next earnings season. I don't think there are any major triggers right now. I think the some of the unwinding of positions can take place, which can lead to some amount of interim volatility. But I don't see any major triggers in the next couple of months.
Okay, so no major triggers that you're eyeing out for. But as a trust, as a mutual fund, you have been holding cash levels around 4,000 crore rupees in equity funds. So when do you think that the right time will come for certain deployment?
Mutual funds are a competitive industry. We have to keep the benefit of the unit holders in mind. So we would not, as an industry, we will not buy just because the markets have come down. If markets have come down because earnings have been revised lower, then that is not a great idea to, deploy cash. From what I have seen is that the cash levels in the industry broadly are around 5%. So one should assume that 2 to 3% would be the normal level of cash in any point of time. So one should just assume that 2 to 3% is the cash that is there, and that can be deployed once the clarity on earnings and clarity on policy emerges. I don't think mutual funds would be in any hurry to deploy the cash that is there. So it's a cash which is not tactical. I think it has been created because of the uncertainties. And unless we see uncertainties going away, I think mutual fund cash will be there. There's steady inflow in mutual funds also. So I don't think the cash levels in absolute terms are going to come down in a hurry.
Okay, okay. But we have seen about 20 to 30% correction in all of the major stocks across the market. So where do you find value at this point of time? Large caps, mid caps, small caps, what are you eyeing for?
See, this large cap, mid cap, small cap is a fairly artificial construct. There are only 100 large cap stocks, only 150 mid cap stocks, and more than 4,000 stocks are small cap stocks. So I don't see value, but I think we see opportunity in the small cap stock arena, small and mid caps more. The large caps have become fairly well researched, and they are far more uh, amenable to changes in the economic outlook and the economic growth. The amount of alpha that can be created is definitely there in small and mid caps. We particularly like some amount of pharma. So I have noticed that we are bending towards pharma because we feel that the export opportunities in pharma are somewhat protected, and on a secular basis, they are likely to trend higher. So we like pharmas at this point of time.
Okay, are you bullish on pharma at this point of time? But Sandeep, we saw record SIP inflows last month as well. So, as a fund house, what do you recommend? What is the fund flavor going on? Thematic fund, index fund, or what are you recommending at this point of time?
I think thematic funds are not to be, invested in unless one has a positive view on the sector or the theme, and one is invested for 3 to 5 years. And I think one should be invested in diversified funds, where the fund manager has adequate flexibility to invest across sectors, across different market caps. And markets are dynamic, and one should give the flexibility to the fund manager rather than do it yourself structure. I have seen a report yesterday that a lot of the recently launched thematic funds are deep in the red, and it may take a few quarters for them to come back to par. So I think thematic funds one should avoid, and if one wants to invest, one should avoid a very small part of the portfolio. I think majority of the funds should be in funds like flexi cap or small caps, which are dedicated towards one particular category, but the fund manager has enough flexibility to change sectors or market caps, depending on the valuations and depending on the outlook changes.
Okay, okay. But since you are talking about valuations, can I ask that how much of a correction do we need to find that the valuations are palpable at this point of time?
The valuations are, they have to be seen in the context of earnings, they have to be seen in context of interest rates. And, earlier the markets were expecting interest rates to come down significantly globally as well as domestically. Uh, but, markets would react more to the changes in short-term rates less to the short-term rates and rather more towards the longer-term rates. In the US, which is the largest economy, we have seen that while the short-term rates have been cut by 50 to 75 basis points, the long end yields, the 10-year yield has gone up by 75 to 80 basis points. So I think markets is paying more attention to the potential inflationary impulse in the economy, rather than the catch-up moves by the central bankers. So I think central banks have sort of, I won't say lost the narrative, but they are behind the curve, and they have printed a lot of money, which is causing inflation. It is likely to cause inflation in the future as well, and they are in a tight situation right now. They cannot possibly increase the quantum of money which they have printed. They are really likely to reduce the quantum of money which is in the system, which will put pressure on flows and on risk capital. However, they will try to reduce the cost of money, but I think inflation will prevent them from going the whole hog. So I think one should not really rely on interest rates to come down and support the markets. So I think valuations can come down a bit more. I think the only saving grace would be if earnings were to pick up.
Okay, yes, absolutely, you're right. But India, that has always been the top destination among the emerging markets. But that is not the case this time, because for FIs at this point of time, since October, we've been seeing quite a bit of a sell-off and quite a bit of an outflows. So do you believe that stronger dollar and yields would keep further keep them away for some more time?
Yes, the selling might wane, the selling might stop for some time, but I think this is some of the excess overweights might have got reduced, and I think there is more than what meets the eye. I think the strong dollar, the high yields, and the fact that that there is no further balance sheet expansion by the central banks, but there is a contraction. I think, and you add to that the political uncertainties. I think this calendar year, I don't see the FPIs really coming back in a big way. So I think this selling might not be at the same intensity, but I don't think that it's going to stop anytime soon.
Okay, all right. But do you think that for a proper bull trend to resume for the Indian markets, their comeback is necessary, or do you believe that the DIs will be supporting any of the up moves?
See, I think the earnings have to come back.
Hmm.
I think that is the basis of any sustainable bull market, and earnings have been quite strong in the recent past. And in the small cap space, I think, which is far more wider representation of companies in India, I think the earning expectations are quite high even now for the next 2 years. So I think earnings have to materialize. The flows will follow the earnings. So we should not really put the cart before the horse. I think earnings will drive the market. If earnings are good, flows will come. If earnings are not good, then flows will be reluctant. So I think one has to really see the context in which we are trading the markets. I think earnings have to come.
Okay. But we did see that the earnings were quite disappointing in Q2 as well. But what does the Q3 hold? What are you anticipating from the India Inc. for the upcoming quarters?
You, you cannot have earnings yo-yo quarter by quarter. I think earning expectations, if they are low, I think earning expectations would, I mean, if earnings have been lower than expected, I think one can expect that earnings would be lower in the next quarter also. So adjusted for seasonality, I think we should anticipate a slowdown in earnings going forward, and reset our expectations lower. And only from there, I think with about after some consolidation and resetting of expectations, we should probably start thinking of the next up move.
Okay. So we need to trim down our expectations at this point of time. But Sandeep,
Yes.
apart from pharma, what else are you seeing as a pocket of value? What do you think about financials or even the IT space after the Q2 performance?
So we are allocating more to mid-cap ITs because we feel that that is something that is going to eventually gain from the US increased spending on IT. And while the H-1B visa concerns are there, but a lot of offshoring is also happening. So I think our IT companies will continue to grow at a very steady pace. In the financials, we are less bullish on lenders like banks and NBFCs. We are more bullish on companies which cater to the financialization of savings and capital markets. So, depository participants, brokers, wealth managers, AMCs, RTA agents. We are more bullish on these type of companies where the growth is palpably higher compared to the traditional banking.
Okay, okay. But Sandeep, we did talk about how Trump's policies, the uncertainty of Trump's policies and the setting in of Trump's policies are awaited for the markets as well. What do you think about the metal counters? Because they have been quite vocal about 60% trade tariffs on China. Do you think that India stands to benefit and stands to remain insulated from these, after this trade barriers if they were imposed?
See, there's a lot of uncertainty.
Yeah.
It's very difficult to differentiate between what is the election rhetoric and what is the actual policy going to be. A lot of times, the statements that are made are, to more indication of intent and bargaining power. So I think market will have to take a more informed decision and wait for, actual policies to unfold, which I think is still a few months away. So I think in that period of uncertainty, one can go a little wrong in terms of trying to judge which sectors will be impacted and by how much. So I think markets will be in a trading range and will not be able to move decisively in lack of triggers for the next couple of months.
Okay. Okay. All right, Sandeep. Thank you so much. With that, we have to let you go. But thank you so much for your time. We hope that we connect with you soon as well.
Thank you so much. Thank you for having me on the show.